Hi, I'm Lisa Wilson, and I will be presenting estate planning, explaining trust. So most people have heard of trust, but many not fully understand what trusts do. So trusts have many functions and different purposes that make trust an effective tool in estate planning. So this presentation will examine what exactly a trust is. So let's look at what is a trust. A trust is a fiduciary arrangement that allows a third party to hold assets on behalf of a beneficiary. So the third party is a trustee and holds the legal title to the assets. So the grantor no longer holds the assets, and the beneficiaries holds the beneficial interest in the trust. So here we're going to discuss the parties in a trust, because a trust is a legal relationship between three people. So we have the grantor, which is the person who creates and funds the trust. We have the trustees, and that is the people or person that manages and have the responsibility for the trust. And then we have the beneficiaries, and these are the people that benefit from the trust. So now we're going to discuss how a trust works. So the grantor will place an asset or funds into a trust called a trust fund. And this will be managed by the trustees according to a set of legally binding rules and conditions for the beneficiaries. And the rules and conditions are normally put into writing called a trust deed, which is binding on the trustees. So let's talk about why are trusts used in estate planning. Now they are used for management. A trust can be used to provide professional management of assets for individuals who are not suited to manage the assets themselves. So take for instance a husband and wife. The husband dies, who was the main caretaker of their finances, and he knows that the wife has struggled managing the finances. So the husband creates a trust to help the wife properly manage their assets. Now we have creditor protection. If property is placed in a trust with appropriate spendthrift protection provisions rather than transferred outright, the creditors of the beneficiary will not be able to access the funds. And then we have split interest in property. A trust can be used to take a single asset or property interest and divide it into different interests to achieve a client's estate planning and wealth transfer objectives. So to continue why are trusts used in estate planning, they are used to avoid probate. A revocable living trust is used to avoid the probate process. All of the individual's property is retitled to a revocable trust that is managed by the grantor and is for the benefit of the grantor during his or her lifetime. And upon the grantor's death, the property passes to the grantor's heirs under the terms of the trust, and this will avoid the probate process, which can be very lengthy and very expensive. Now, trusts are also used in minimizing taxes, because tax savings results from the transfer of future appreciation to the grantor's heirs, the minimization of transfer taxes on subsequent generations, the reduction in size of the grantor's estate, and the reduction of income tax for the donor of the income produced on the transfer assets. So I'm going to talk about the different types and classifications of trust. So a revocable trust, the grantor retains the rights to revoke the trust at any time prior to his or her incapacity or death, and are commonly used to avoid the probate process. Irrevocable trust, the grantor cannot take back the property in the trust. It cannot change. Inter vivos trust, any trust that is created during the lifetime of the grantor. A testamentary trust is created after the death of the grantor, and the grantor leaves instructions in his or her will for the executor to create and fund a trust after the death of the grantor. A standby trust is created in a grantor's lifetime that is either unfunded or minimally funded, and the trust stands by for a triggering event to activate it. A pour-over trust receives assets from another source, generally the grantor's estate, at the grantor's death. And then we have a grantor trust. The grantor of the trust is responsible for paying the income tax attributed to the trust income. A inter vivos trust is any trust that is created during the lifetime of the grantor. A funded and unfunded trust. Funded means a trust that has had assets transferred into the trust. And then an unfunded is a trust that is drafted and awaits property transfer. So an unfunded trust technically isn't established until the property is transferred into it. And then a simple trust is any trust that requires all of the trust income to be distributed on an annual basis and does not include a charitable organization as a beneficiary. A complex trust is a trust that is permitted to accumulate income or a trust that may make distributions to a charity. Life insurance trust just prevents an insured party from having incidents of ownership in the life insurance policy to avoid estate taxation. A bypass trust is a legal arrangement that allows married couples to avoid estate tax on certain assets when one spouse passes away. So the surviving spouse does not own the assets, but has access to the trust and receives an income from the trust. Power of appointment trust grants power of appointment over the trust assets and are used to take advantage of the unlimited estate tax marital deductions. So they also use to avoid generation skipping tax transfer. A qualified terminable interest property trust is created at the death of the first spouse and grants the surviving spouse a lifetime right to the income of the trust while transferring the remainder interest to whom the grantor chooses. A grantor retained income trust is used to minimize taxes on large financial gifts and family members. So the grantor must pay a tax when the trust is established and assets are placed under the trust, and then an annuity is paid out every year. So when the trust expires, the beneficiary receives the tax-free assets. And so this is also called an A and B trust. A dynasty trust, those are arrangements designed to last for a very long period of time. Dynasty trusts are used to avoid transfer taxations at the death of each generation. A crummy trust is a trust agreement that allows the beneficiary to withdraw the contributions made by the grantor to the trust. A charitable trust enables individuals to transfer assets to charity in a tax efficient manner and to assist in estate planning by transferring assets to a non-charitable beneficiaries. A blind trust is a revocable trust agreement whereby an individual transfers property to the trust for management purposes when a self-management of the assets might be deemed to be a conflict of interest. So commonly is used by politicians to provide management of their assets during their term in office. And lastly, we have a blind trust. And these are used to provide benefits to persons or beneficiaries with special needs. Typically are established to ensure the benefits available from the federal state agencies are preserved and maintained. I covered a lot of trust and their classifications, but I did not include all of them because there are many types of different trusts and they have many types of functions. Now, why are trusts used in estate planning? So the most common reason to use a trust in an estate plan is to avoid probate. Irrevocable and revocable trusts both help in probate avoidance, and avoiding probate will save the family money from costly probate cases. And to continue why we use trust in estate planning, a trust also provides privacy, and this is important to some people because the probate process is publicly available. So any information on the assets are made public, and people who are in the public eye may want their financial matters private. So to continue on why we use trust in estate planning, an individual may set up a trust because the heir may not be financially savvy. So a grantor can set up a trust for a spouse because the spouse may not manage money efficiently, or the grantor may also set up a trust because his or her kids are not of age or responsible enough to handle the assets. And to further on with why we use a trust in estate planning, a living trust can give a trustee the power of control over the assets in a case the grantor becomes incapacitated. And lastly, why we use trust in estate planning. Some trusts can also shield assets from creditors upon the passing of the grantor. So trust can also shield individuals and keep their money safe from lawsuits or legal haggling over an estate. So in conclusion, not all trusts are created equally, so it is important to know and understand the client's needs and estates before transferring his or her assets into a trust. Because trusts provide a way to minimize estate and transfer taxes, privacy, control, estate protection from creditors, and lawsuits, and probate avoidance. They have many functions and different purposes that make trusts an effective tool in estate planning. So thank you for viewing this presentation, and I hope I was able to explain trust in estate planning.